welcome. You're watching Financial Planner, and today we're going to talk to you about why selecting the right mutual fund is one of the most important parameters of planning your finances. To talk to us about that, we have with us Feroz Aziz of Anand Rathi. Thanks, Feroz. Thanks for joining us today on the show. To begin with, Feroz, selecting the right mutual fund is one of the most important aspects of planning your finances. But start by telling our viewers why investing through the mutual fund route is what advisors like you tell retail investors to do.
I think there are three primary and large reasons why you should use a mutual fund as your vehicle to participate in the cash market of buying stocks. Point one, it's not a part-time job, it's a full-time job. And most of us have something else to do. It can't be done during lunch breaks. Okay, there is a large army of analysts who need to figure out what are the kind of profits a company will make and then buy them for you, not on hear and say. So professional management in each walk of our life we choose to have. And something as important as money, not having professional management and thinking that I can do it myself could actually leave you dented on your financials. That's point one.
Right. Also, Feroz, creating wealth is why we tell retail investors and our retail viewers to make investments. Investing through a mutual fund, of course, like you indicated, is a preferred route because there are experts sitting out there who can help you and who do this as a full-time job as opposed to a lunch break or a dinner table conversation. But when you select a mutual fund, or rather, what is the objective of a mutual fund? How does one determine whether or not they've been successful in selecting the right mutual fund, or they've actually made the wrong choice and failed?
So yeah, it's a very, very valid question, just like you ask all valid questions on behalf of our viewers. If we don't have the objective clear, you would not ever get to know whether the objective is met or not met. And you might take decisions which are not the right conclusions when it comes to investing in mutual funds. So objective for choosing an equity mutual fund, for example, should be to generate 4 to 5% more every year than the benchmark indices. Now, very importantly, what should be your benchmark? Because Nifty or Sensex are the most popular indices. If there was no professional management, most often than not, as an investor would choose these two indices because it's a popular index. He's not going to, or she's not going to choose a BSE small cap index, which people may not be aware of what the number is today. So the point is, make sure that your objective of equity mutual fund choice is not very aspirational, 4 to 5% more over and above the index. An index could be as simple as Sensex, is a good objective to have. Why is this sufficient to be successful? Is because if you compound your money 5% extra for long periods of time, which is what most retail investors have in their favor, because their retirements could be 20, 30 years away, the kind of value in rupee terms it can create is enormous. For example, 100 rupee grown at 7% will become 200 in 10 years. Grown at 12%, which is 5% more because of the fund manager's intellect, 100 rupee, instead of growing to 200, 100 will become 300. So for every 100 rupees, you got 100 rupees more after 10 years because you choose the right fund manager and get this 5% extra year on year on the index, which was your other alternative if not for a fund manager.
Right. Feroz, I believe there are 431 open-ended equity schemes, over 1,000 debt schemes that are open-ended. Now, this is an extensive list, and I'm guessing a lot of those would give you that beat of about 4 to 5% on the index. I'm not sure, you can correct me if I'm wrong on that. So how does one go about doing the selection? Well, of course, the importance of this is to beat the index, and I guess that could be one of the parameters. But beyond that, is it as important to be picky and look at this process of selection as important as it is to equities, as it is to debt, or one takes precedence over the other?
I think there are 2-3 questions in your question. Point one is a large portion of this universe of this 431 equity schemes for the moment, if we say, are they beating the index? In our opinion, in India, if you look at the last 3 years and look at longer periods as well, 85% of these funds have beaten the index.
Okay.
So it's very important to rest this debate in Indian context, whether should I go for a passive strategy or for an active strategy, should I buy an index fund or should I buy a actively managed fund by a good fund manager. That debate is put to rest with this mathematics. Unlike in an emerged market like the US, for example, 70 to 80% are struggling to beat the index. So if there is sun shining today in our economy and the environment, because it's not as mature as an emerged market, should I take the benefit of it? Because it's a large impact benefit, I would take that benefit. Even large clients fall for this trap of saying low cost index fund is a better strategy, but mathematics clearly indicates that you should not take a passive strategy, take an active strategy in India till the sun is shining. And if at a point in time, if this extra return reduces or diminishes or becomes negative, then you will have to relook at the strategy. That's point one. Point two, in debt, selection is not as important as in equity.
Okay.
And that's a very valid question because in debt side, the best and the worst scheme have a very little difference. So even if you went wrong, the impact of going wrong is very low because the best and the worst scheme would have a difference of 2.5%. But the best scheme and the worst scheme in the equity category every year has a 30% difference. 30% difference if you could go wrong, and it will cost you 30% per annum. And that's a large cost to pay. So selection of these from these 431 is more important than the 800,000. In spite of the universe being larger there, equity mutual fund selection is a far important element which your strategy has to be put in place far more effectively.
How often do you advise an investor, a retail investor, to sort of undertake this process of selection? Is it supposed to be annually? Is it supposed to be, quarterly in some cases? Is it supposed to be once every 3 years? What is the kind of time frame one looks at while we sort of analyze the mutual funds that have performed or not performed in some cases?
See, unfortunately or ironically, people choose on the basis of past performance. If they choose on the basis of past performance, their longevity of a scheme performing after having performed already before you bought is very low probability. So you will have to make more changes if you did past performance analysis to make your investment decisions. If you did some degree of more homework and tried to find out the future performance indicators, not perfectly, but there are indicators, there are trends, and there is something spoken about the fund which tells you the future prospects. If you're choosing on that basis, then I don't think you should make a change for 2 to 3 years at least in a scheme, which is the basic time a professional will need, and if you empathize with them, will need to prove their point and their value. It's not going to happen in 6 months time frames.
Right. On that note, we'll take a break. We'll come back. The factors that you need to focus on while you make that selection. Welcome back. You're watching Financial Planner, and today we're talking about why selecting the right mutual fund is one of the most important exercise one needs to undertake while planning their finances. Feroze, we talked about why one should be choosing mutual funds. We've also talked about the objective of a mutual fund. You've also told us that a number of mutual funds available for an investor, and what is the process of selection is where we're coming down to now. Most retail investors that I know and we talk to go and invest in mutual funds that come with a strong brand. So funds from a Kotak, an HDFC, ICICI, SBI are ones that will feature on most retail investors' lists because I guess there's some comfort with one associated with a long-standing brand. Is that an important parameter to begin with?
I think, of course, if you just go with brands, you will miss a lot of funds which have merit and they're meritorious to be a part of your portfolio. If you just go top down saying that these are the 5-6 brands I want to focus on because they inspire trust, which is logical enough because you're giving them something which you possess, which is very dear to your heart, which is your money. So brand is going to be a very important attribute. But there has to be more science than just the trust element which is inspired. So your first filters of these 431, which shrinks the universe down, have to be very carefully chosen. After doing a lot of analysis, we have come to this conclusion that these two filters, which I'm going to mention, are a good method to not go really deep down to the last fund, but also not stick to the only brands. So somewhere in the middle is the solution lies somewhere in the middle. So the first filter is, don't choose an asset management company which is managing less than 1,000 crores of equity mutual fund
The
assets.
size of the AMC is what's most important.
Correct. And 1,000 crores is not a very big size when it comes to asset management companies across all equity schemes put together. If they're not managing 1,000 crores, then it's unlikely for them to have an army of analysts supporting the fund managers. And we have seen that the average number of analysts have a very strong correlation to performance. And if you are managing only 1,000 crores, you will have 4 analysts. But if you're managing 50,000 crores, you will have an army of 60 analysts is the average. So it's important to not touch asset management.
Getting too large can also become a problem. Is there like an upper and lower band? So lower band we've talked about. Is there an upper band as well that one needs to be concerned about?
Yes, you've again brought us to a topic which is scientifically proven that as size goes up, it becomes tougher for the fund manager to be agile and move around and create performance. So any scheme, when it comes to size, it is not the fund. It is the scheme which you need to be worried of. Now, this 1,000 crore limit which I'm telling you is the cumulative, all schemes for that specific brand. But when it comes to size, it's important to not be wary to invest in schemes which are more than 15,000 crores. That's what research says, that 15,000 crore plus specific single schemes find it difficult. Not that they can't, but the odds are lower for them to generate huge values for you.
And what is the lower end of the band when you look at a scheme's assets?
When you get to scheme assets, which should be a second filter, even 100 crore scheme, 100 plus crores is, I think, the bare minimum you can touch.
And maximum?
Maximum, I don't see that as a limit, but you have to be wary and have a stronger reason. You need to have a very strong reason to buy a 20,000 crore scheme.
So once we've put that filter in place, how many funds are we left with? You have 431 open-ended equity schemes and over 1,000 debt schemes. Do you have those numbers on you? What do we come down to then?
We come down to 248.
So we've done 50% has been eradicated right there.
Almost about 40-50%, like you rightly pointed out, have now, your universe has shrunk. And that's a very important thing. And
that's equity open-ended schemes.
Equity open-ended schemes.
Right. And so if you can break that down for me, of the 200-odd schemes that we are now left with, there are large cap, mid cap, index, small cap funds, large cap funds. A lot of that is also irrelevant to a retail investor, given that you've only got about 2 to 3% of India that actually invest into these mutual funds, right? So for a beginner, for someone who's not doing this full time and who doesn't have as much understanding of financial markets, what do you think is important? What types of mutual funds here are going to be important? Would you go after a small cap fund because it may be irrelevant if you're a first-time investor anyway?
Correct. I think like you rightly pointed out, in this 248, if I have to give broad categories, there are 7.
Okay.
7 broad categories. Like you said, 98% of India has not so far invested in mutual funds. So nobody is going to be clear to what kind of categories are relevant to them. So to simplify it, I think out of these 248, there are 88 in the large cap category, 51 in the mid cap category, and these are the two most important categories for a fund, for a new investor. Apart from that, there is index funds, balanced funds, sectorial funds, international funds, and ELSS. These are the 7 broad categories in which these 248 will fit in. And mid cap and large cap are the 2 most relevant. Even small cap is not relevant at this stage for a new investor. One other category which is relevant from a taxation perspective is the equity-linked savings schemes. So these 3 categories out of the 7 encompass only about 130 to 150 schemes. So now your universe shrinks from 431 down to 248, now even down to 150 schemes.
Right. So when we come down to 150 schemes, Feroze, what I want to understand from you, we said that ELSS are probably feature on the list because they're more tax efficient. The rest of the mutual fund universe is uniform in terms of taxation?
Yes. See, when it comes to taxation, all these are equity category. So they come with a taxation of 0 taxation beyond a year. Okay. Because it's long-term capital.
And it's uniform across the board.
What in ELSS is distinctly different is that when you invest, you also get a tax rebate on your income which you earned for that year from your employer. So that's an extra benefit apart from the benefit of long-term category. Because of your lock-in feature of 3 years, which all ELSS schemes are mandatory to have, you get a tax rebate. And if your incomes are X, if you've made an investment in the Section 80C, you get a tax rebate. So you get two benefits. One is a tax discount and tax-free gains. These are the two.
And the reason I ask you this is because I'm sure retail investors sit back and think we should invest in mutual funds because it's more tax efficient, and that's probably what the thinking could be more often than not. So just to recap, once we put these two filters in place, which is one, beat the index by about 4-5% in the size of the fund and the scheme, just for the sake of our viewers, once again, reiterate how many funds we are left with.
We are left with 88 in the large cap category.
88 large cap.
51 in the mid cap category.
And that's pretty much all that's relevant to a retail
And then
investor.
about 30 odd in the ELSS category. 28 if I'm not wrong.
Right, of course, it doesn't end there. We'll take a break, we'll come back, we'll continue our conversation and tell you how you should be selecting from the 80 odd large cap, 51 mid cap and 30 ELSS funds that are available at your disposal. Welcome back. You're watching Financial Planner. Let's now talk about how does one actually select the right mutual fund for your investment. We've already come down to 88 large cap funds, 51 mid cap and 30 ELSS funds that are available or advisable to look at for a retail investor. Feroz, more often than not, one of the common parameters that a retail investor uses while investing into funds, apart from the brand loyalty, is past performance. So if a fund has done exceptionally well in the past, most investors believe that the performance in the future will come from the past. Is that the right parameter to use to begin with? I mean, is that even advisable?
See, I think, unfortunately, past performance is a reasonably bad indicator of future performance. Okay, like the mutual fund advertisements, for example, give this disclaimer: past performance is not an indication of the future, which is actually true. So we did some analysis and realized that the top 10 schemes of the last year, for example, only 2 of them remain in the top 10 the subsequent year. So, and this analysis we did for 20 years and realized that if I chose on the basis of the top 10 schemes of last year, those don't remain. Only 2 out of those 10 remain. So this is a scary stat, saying that I can't base my investment decision on past performance because math clearly says only 2 will be the top 10. So I might be very likely to buy the rest of the 8 and I don't be in the top 10. So chasing your own tail in making investment decisions is not a very prudent thing to do.
So then how does one determine what's going to work and what's not going to, looking into the future? It's almost like being an astrologer and a predictor, what's going to work for you or not. In this case, I guess a lot more science goes behind it.
Correct. See, for example, if you're an advisor, and then it becomes your duty to after seeing this data, go in search of methods which are there in the books and academicians' languages, which can help us make investment decisions in a more scientific fashion, not just on the basis of past performance. So we discovered a few years back, almost a decade back, I realized that there is one method called regression, which helps us anticipate the future in a better fashion, not in a perfect fashion, but in a relatively better fashion. That subject is called regression, which tells you, don't look at past performance, look at some 7 other indicators, out of which only 1 of them is a past performance indicator, 6 of them is not past performance. If you choose on that basis, will you get the best scheme? The answer is no. Will you be able to meet your objective of getting 4-5% extra return in the index? High chance. And these 7 parameters is what you need to look at in a specific weightage, rather than just look at the one weightage, which is past performance.
So beyond past performance, which is probably the easiest of those parameters, what are the other 6 parameters that one should keep in mind?
So I think before I go to those parameters, like I mentioned, let me also tell you and caution you that regression only helps you better predict, not perfectly predict the future, because it's not possible, right? Now, out of those 7, for illustrative purposes, let me take one of them. Okay, down capture ratio. Down capture ratio has a strong correlation to future performance. It tells you how much of the negative performance does a fund manager has a propensity to capture? So it's very good if he captures more of the upside, which is called the up capture ratio, but he captures or she captures lesser of the downside. So higher the up capture ratio, lower the down capture ratio, I would prefer that scheme, which might not be captured in the past performance entirely. So down capture, up capture are the two out of the 7 for illustrative purposes I was just mentioning.
Right. Also, one other tendency that people go after is the fund manager's investment style. Is that even relevant?
See, fund manager's investment style is important. What is more important when it comes to those specific 143 human beings? Actually, these 431 is managed by 143 human beings. We just sometimes get carried away with the names of the fund. We should actually be looking at the person behind it. It's important to figure out how is their decision-making capability. So if some homework is to be done, you can actually cull out the 100 decisions each of these human beings have taken. If they have taken 70, 80 right decisions, then those are the guys who actually are capable of carrying a fund manager tag. So you put the second filter. One is the scientific filter of regression. Second is to say their job is to take decisions. Why not go to the depth of it and see what were the decisions they took, which is available information, and see what is their right to wrong ratio. If somebody's got 50 right, 50 wrong, I would say this is law of probability. I would, anyways, if a child starts taking decisions, he will go half the time right and half the time wrong. But he needs to, she needs to, as a fund manager, take 70, 75, 80% right decisions. Then those are the fund managers I can be associated with, I can be confident about. In the bad times, I will stay on, because I'm confident about the fund manager. So that's the second filter.
Feroze, another qualitative aspect of a fund manager could potentially be where he's agile and moves quickly between stocks, or of course, accepts that he's made a mistake and moves on, because it's only human to err. But there are some fund managers who'd stick with their decision and play the long haul. Is that an important parameter? Because that again is a personality trend, which is very tough to call as an investor, right? But would be important, I'd imagine.
Absolutely, Samina. I think investment is both the heart and the mind. So there is the psychological aspect of the fund manager, which by virtue, if a person is good at a profession, there is some degree of pride to not acknowledge that I went wrong. And there could be a large damage if you can't bite the bullet and quit the game and acknowledge that I went wrong. So it's a very, very important parameter, tougher to measure, but nothing to take away from this valid point. And I know for a fact, without mentioning the fund and the fund names, I have seen ego tussle, and that not resulting in a huge damage for investors in the tune of 5-6% negative alpha. So that's a very subjective thing. So you need an army of people to meet these fund managers to understand the personality traits.
And how important is this qualitative aspect? Because if a fund manager leaves one AMC and moves to another, would you advise your clients or our viewers that they should move with the fund manager?
I think yes and no.
Of course, if a style is what matches your sort of objectives.
See, if you are with the top 5 asset management companies, then you don't need to move. But if it's a smaller asset management company, it's a structural change in the scheme. Anything which is a structural change, not an expense ratio change, is immaterial. The fund manager whom you analyzed and bought, and he is no more or she is no more with that fund, it's a very strong case to consider.
There's been recent news development where the funds are going to be forced to consolidate because of the kind of overlap that large, mid-cap, small-cap funds are currently witnessing. Do you think this process that's going to go underway is going to make it a whole lot easier and probably bring down these funds to nearly half?
I think again you've brought a topic which is the 431. The filters which we have put of less than 100 crore schemes, in my opinion, very few of them will exist after this consolidation. So this filter till the SEBI circular, which is still not implemented, but it's very seriously on the process of being implemented. So I think that will bring some degree of simplicity for investors.
Very lastly, for the sake of our viewers, you've got this whole process down under. Can you help us and tell us the 5 top large cap funds that you're currently recommending, 3 mid cap funds, and maybe 3 ALSS funds that one can look at?
See, let me shrink the number 7 which you've asked to about 6-7, because the optimal number of schemes should not exceed 7 in statistically in one's portfolio. So 3 large cap schemes which are not just on the basis of past performance, also using regression. One of them is Mirae Asset India Opportunities. Kotak Select Focus, and the third one would be a SBI Blue Chip Fund. These are the three large cap schemes. You might see that the performance of SBI Blue Chip would have been bad for the last 1 year, but it is from a regression perspective, it's still in the recommendation list. Then coming to the mid cap space, you can look at HDFC mid cap opportunities, which of course has a very large size, but Chirag Setalvad has very good capability of doing stock picking, so that will still be in the recommendation list, irrespective of the size which it has crossed of 20,000 crores. Then you have Canara Robeco Emerging Equities, which are the two mid-cap schemes. On the ELSS category, let me give two, because it's the season of tax mitigation, which is Reliance Tax Saver and Access Long-Term Equity. These are the two schemes on the ELSS side. So these are the 7 schemes. If one creates a portfolio, I think he or she should do reasonably well.
And like we said earlier, if you're going to use the right parameters to sort of select the mutual fund, you don't have to review this very often, right? So how often will you evaluate how your fund has performed, or whether it's time to change or not?
See, I think if you have gone this path of trying to use the future analysis, it's important to stick to them for 2 years, and then look at shows like this, and again why this specific show, and then take a call in terms of any change and modification is recommended.
Right, that's, I guess, all the time we have on this edition of Financial Planner. Thanks for watching. A lot more programming on the other side, so keep it with us.